Hello, this is James Graff with Advisors Mortgage Group with another Mortgage Minute. This will take more than a minute. We're going to talk about the FHFA's new fee/tax on refinances, which regards all of those done through Fannie Mae and Freddie Mac. I'm going to read this article here and we can talk about it. FHFA drops a bomb. Your refi or refinance just got much more expensive. I don't know, much more. I mean, if you look at the total cost over the lifetime of the loan, yes. Okay. This is from August 12th, 2020, 9 p.m. And what can only be described as a cash grab. These are the writer's words, not mine. Fannie and Freddie's regulator just announced a new tax on refinances. Granted, it's not technically a tax, which is important, and it wasn't probably even intended to hit the pocketbooks of the American homeowner. But that's unfortunately exactly what it will eventually do. I'm interjecting now. So we're going to have to break it down. It's technically a fee. It's a 0.5% fee. We'll get into it. Here we go. This is what was announced. The FHFA, which is the Fannie and Freddie's regulator, those are GSEs, government-sponsored entities, is implementing a new price adjustment for all refinance transactions of 0.5% of the loan amount. For example, $1,500 on a $300,000 loan. This applies to loans delivered to Fannie or Freddie in September and thereafter, so starting September 1st, which is almost all of them that aren't already well underway. We're getting there. There are some loans that are locked. Question is why? Why would they do this? They're saying, and this is what they're claiming, is what they're claiming true? I don't know. Here we go. They're saying it is due to economic and market uncertainty. There's always uncertainty in the market. Okay, moving on. Some might consider that hard to swallow because this fee didn't exist last week or last month, but economic market uncertainty definitely did. That was my point exactly. Economic and market uncertainty exists all the time. And it goes up and down, I suppose, depending on your opinion. So I guess we're going to get into the real reason here. Lenders' margins are wide. In other words, lenders haven't dropped rates as much as the bond market would allow them to. A decision driven by necessity due to capacity constraints amid a refi boom and unprecedented workflow hurdles created by coronavirus rather than simple greed. So basically, it's tough times for everyone, including people in the lending industry. There's a huge amount of people that need their mortgages refinanced, which causes a great stress and a load on all those lenders and all of the people basically processing and underwriting and originating those loans. It takes a lot amount of effort, and it's like a small pipe with a large flow through it, unexpectedly large flow, and so there's capacity constraints, and basically they're saying that it's necessary to keep the margin a little bit higher so they can hire more people to process quicker, blah, 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 blah. That's what I think they're getting at there. FHFA sees the wider margins and concludes lenders have extra profit to spare. Does that make sense? No, it doesn't, because there may not be profits to spare. Yes, they're making, I guess, more fees per loan, whatever, but those fees go to pay people and go for services, and I'm not sure that's true. Right? That's their assumption. That money would help further the FHA's stated goal of building capital reserves of the GSEs, the government-sponsored entities, which are basically Fannie Mae, and Freddie Mac, basically. Building capital reserves of the GSEs sufficient to end the government's conservatorship of the agencies. They're trying to cut ties, I suppose. Conservatorship. So they're being conserved by the agencies above them. In simpler terms, FHFA is saying to lenders, quote, I think some of your money should be our money instead. Again, these are not my opinions. This is the author here. Rest assured, this fee would never have been considered if rates were higher and lender margins were thinner. Which, again, these are contentious arguments. Can you prove these statements? Rates higher, yes, definitely. But margins, thinner margins are pretty thin to begin with, I think. But since rates are so low and margins are so wide, which they're not really, because, like as we said, there are costs involved, so that affects your margins. Who's going to complain? Like, plenty from everyone. There's enough refinancing for everybody, enough refinancing money. This is false thinking, by the way, in my opinion. This is my opinion. There's not enough money for everybody. It's going to eventually affect the people most affected by the coronavirus and the COVID. So here we go. So who is going to complain? Ultimately, homeowners. The people holding the mortgages are going to eventually carry the costs of these things, which is counterproductive in pretty much everybody's opinion. The Fed is trying to do the exact opposite. They're lowering rates to make it easier on mortgage holders and landlords and people that might be evicted or not evicted because there's mortgage pressures, blah, 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 blah. So anyway, the mortgage community is going to get things started, though, right? So the lenders will pay the first month or so, or I'm not sure how long they'll be paying their portion of that fee, because they can't pass it on if the rates are locked. So lenders have tons of loans that are already locked with expiration dates after September 1st. They're going to have to eat 50 basis points on all those loans. For big lenders, that is tens of millions of dollars in instantly vaporized profits. Of course, Advisors Mortgage Group is not a giant lender. It's not a big bank, right? So it's going to affect everybody, evenly. And the big banks who do have cushion are going to get squeezed less than the mom and pops and the little smaller lenders. This is my interjection, of course. Mom and pop lenders, newer lenders, smaller lenders. Advisors Mortgage Group started in 1999. It's quite big and successful, but it's not the size of, let's say, Wells Fargo. Anyway, I'm not allowed to talk about Wells Fargo. Oops. So, moving on. We're not going to mention names. I just did. Forget I said that. The other big banks, let's say. So, again, FHFA's rationale is likely that lenders have excess profit anyway, so they can absorb this. Again, I don't see that to be true for smaller lenders. Bigger lenders, perhaps, they can eat the costs, but smaller lenders, I'm not so sure. I truly hope that's not their rationale, but if it is, they're dumb. That's the writer's opinion. Anytime regulators jack up fees for lenders, it's the consumer that ends up paying. I'm not saying that because it sounds sensational, but because there's a consistent track record of correlation. This is just simply how the markets work. That's how markets work. Taxes, tariffs, all these things always ultimately end up in the price tag to the consumer. This is just basic economics, really. So, in fact, lenders are already sending out reprice notifications to raise rates for those loans still eligible to lock today. So that's already happening. In other words, if it's not already locked, your refinance just got hit for 0.5 points. I'm not sure if that's true either. I think the rates are going to go up less than that. That's my opinion. Should be good for about less than a quarter point, I think. This is my opinion. It's not going to go 0.5 points. It may eventually, but short term, I don't think so. Does this affect purchases? No. You're in luck there. FHFA's explanation, however, is further out of luck. Think about it. Why would, quote, market and economic uncertainty affect refinance mortgages and not purchases? There's a fallacy there, right? I'll tell you why. Many lenders currently have higher rates for refis versus purchases due to the insanely high refi demand. So if there's a huge influx of refinance demand, refi rates are going to be increased by those lenders who don't want that much in their pipeline, can't afford to do that many. They're just going to raise the price and not hire extra workers to process and underwrite and originate, which smaller lenders might. I'm not sure if I'm allowed to name names, but I know for a fact that Advisors Mortgage Group is hiring more people to handle the extreme demand so that we can get everything done on a timely manner. The client's needs are what drives the company's efforts almost in every aspect. So, moving on. Those higher rates mean the lenders have higher margins and more profit on refinances. Again, for a larger lender, that's true. For smaller lenders, that's not true. I don't think that's true. More profit that the FHFA would like to take, but again, they're actually taking it from consumers. So at first, they will be hurting the lenders who are trying to help people in this debacle. We're trying to avoid evictions or closures. I thought the Fed and the government wants to avoid these things, and the lenders are helping out in that regard. So it's very confusing to me. I mean, it's not confusing, but it's disturbing that they would levy this tax at such an inopportune time, honestly. They're taking it from consumers, basically. Here forward, maybe for a month or a couple of weeks, they'll take some from big banks and smaller lenders, but then it's going to get passed on to the consumer, unfortunately. That's just how the market works. I'm sorry. Is this as horrible as they make it out, as I'm making it out to be, and this author here is making it out to be? I would say, yeah. This is one of those really horrible taxes. It's effectively a tax. They called it a fee. They called it repricing, whatever they want to call it. It's a tax on consumers at a very bad time when you shouldn't be taxing these consumers who have mortgages to pay. You're going to increase foreclosures. This is my opinion. Okay, so is this bad? Yes. It's a bitter pill to swallow and a very low-class move, I'm quoting the author, given the issues facing society at the moment. Granted, the FHFA likely doesn't see it that way, which boggles my mind. Well, how could they not see it that way? Of course, it's how they see it. They know the industry. They're experts on the topic, and they know exactly what they're doing. It's a money grab. It's a cash grab. They likely don't think or believe they're taking money out of consumers' pockets, but years and years of past precedent prove that's exactly what's about to happen. Is there anything we can do to avoid this matter or make it better? No. They're the government. They're here to help. These are all quotes from the author. I can give you my opinion in a very limited basis as an Advisors Mortgage Group employee. I can speak my own mind as an American. I cannot give you the opinion of Advisors Mortgage Group. I'm not allowed to do that. None of these opinions are Advisors Mortgage Group whatsoever. None of these are FHFAs except the one I quoted. I quoted what they said. I think I made that clear. These are all opinions of the author of this article, which will remain nameless for some little bit of protection. I have given you some of my opinions, which I probably should not be giving, but I want to be forthright, and I need to give my clients and my customers all of the information that they need to make proper decisions going forward. If I can't be forthright and honest with my clients, I can't do my job. That's my job. So that's been another Mortgage Minute with my opinions and the author's opinions, but none of the opinions can be associated with Advisors Mortgage Group whatsoever. And I'd like to thank you for listening thus far and hope that you have a fantastic day. Thanks again for listening.